Hey guys, welcome back to another video by Fully Informed Trade, or FI Trade for short, knowledge for everyone. My name is Alex Cho, and right now I am going to be talking about stocks. So here's just another FI Trade presentation. Okay, so today let's start with the main headline, Apple. Now let's go ahead and take a quick look at the chart, see what's happening. Now, as you guys can see, Apple has this long candlestick pattern. So there's like this little tail that came out from the candlestick, and then it shot right back up. So what happened mid-session was basically a lot of people sold the stock, and then all of a sudden people just started snapping it up. It's really weird. I mean, they decided to just start buying at $510. Now, do I think that $510 is a good entry place? And I really don't think so. I think a much better place would be at the 200-day moving average. And the 200-day moving average, which would be right here. So the 200-day moving average at around $480. I think that's a much better place to make an entry on the stock, but not necessarily at the 520, 515 area. Now, I think a lot of people just hit the trigger, and a lot of shorts might have been covered, but I think the main idea that what happened today was a lot of investors just decided to buy now. They probably thought that this would be a great time to be an investor into the stock, and it's not a matter of whether or not it's an ideal price. I think they're just dollar cost averaging, and this just happened to be the day asset managers wanted to be heavily invested into Apple. Now, I think Apple has much more downside, but if there was ever a reasonable place to buy Apple stock, it would be closer to $480 per share. Now let's move on to the next chart, which is Bud Light. Now, not really Bud Light, it's Anheuser-Busch, but the ticker symbol is BUD, and we all know what BUD or Anheuser-Busch is about. It's about selling beer. Now, again, Anheuser-Busch, it has had a bit of a correction, but this is a 3-5 year chart, and we've seen in the past that it would fall down a little bit, then come back up, fall down a little bit. And I'll be honest with you guys, I've never seen beer sales fall, or I've never seen beer sales drop or stop growing, even in the recession. Now, why am I mentioning a beer company? Well, it's very simple, guys. If there's one type of investment I would be very comfortable with buying, it would have to be Anheuser-Busch, because, even if the economy is in the tanks, it sucks, people still have to get their beer. And they have to get it at the tap. They buy it from the convenience store. It really doesn't matter, though. It's non-cyclical. It's defensive, and being defensive right now could be far more rewarding than trying to take on any additional risk. So, okay, let's move on and let's talk about a major ETF, which is the EUFN. So this is the iShares MSCI European Financial ETF. So let's go ahead and talk about this one right here, real quick. So, what's so important about this? Right? Well, again, it broke down below the 200-day moving average. It broke it down. It's closed below the 200-day moving average. So it's likely that European financial stocks are now confirmed to be heading much lower on a broad basis, and specifically European financial stocks. So if European financial stocks are going to be heading into a much stronger and more severe downtrend, that's just bad, guys. I mean, it came back down to what are the type of short setups I'm looking for. Insurance companies is a good start. Prudential, WellPoint, Aetna Insurance. But another place to look at is financials. But which financial companies? Well, it's very simple. It's European financial companies that you would want to short. Now, what kind of European financial companies? Well, preferably European financial companies that have weak balance sheets. But if you can't really find them, it doesn't really matter. It could just be Credit Suisse. It could be any European bank, and they will be sold anyway. So let's move on to the next chart. Now that we've discussed and thoroughly thought about European financials, let's look at the Euro-US dollar currency pair. Now, the Euro-US dollar currency pair is also falling apart on the session, and I just want to mention to you guys, the Euro-US dollar did break below the 200-day moving average. It's likely that it will close below the 200-day moving average, and so as long as this negative trend continues, that's going to keep the dollar propped up, and so as the dollar remains propped up, it's likely that stocks will have a hard time advancing, and a devaluating Euro-US dollar is, in fact, a negative indicator. Now let's talk about how bad is it in Europe. Like, really, how bad is it for European stocks, knowing that we are dealing with a European recession? How bad is it for the equities in Europe? Well, I'll give you a quick example of that. Let's look at France Telecom American Depository Share. So let's look at this real quick, guys. Now, this is the France Telecom stock, and as you guys can see, it was at $22, I believe. Maybe I'm wrong. I can't tell. Yeah, $24 at the beginning of the year, and now it's trading at $10 per share. So what's the point? The point is very simple, guys. Economic recession in Europe, worsening economic data, and kaboom, all European equities are sold heavily. Will this trend continue? Yes, it is likely that it will continue. So, now that we've thoroughly talked about Europe and its woes, not like we really want to hear more of it, but let's go ahead and talk about something else, gold. Now, gold, yesterday I was talking about it, I was thinking it was double topping. I'm not that optimistic on gold. Well, gold continued to fall today, so let's go ahead and talk about gold. Now, gold, I am a bit of a pessimist. Why? Well, because it seems like it's just continuing its downwards trend now. If it's continuing its downwards trend, then it is likely that the price of gold will continue to fall. It is very simple, guys. I don't know what's so difficult about technical analysis, but yes, it is closed below the 20-day moving average, and since it has closed below the 20-day moving average, it is likely that it will continue to fall below the 20-day moving average. Which means that not only is a short-term negative, but I still think that there's a negative longer-term trend in the works in both the gold and silver market, which I'll talk about silver pretty soon. So what are some stocks that I feel comfortable with? So I mentioned beer. So what would be the next thing? Well, okay, it's cigarettes, guys. It's not hard. Cigarettes, see? Yes, Lorillard stock has been in a downwards momentum, and it's fallen a little bit, but it's hitting that horizontal trend line, and it's bouncing off of it a little bit, right? Now, it may have continued to fall a little lower, but I've never seen cigarette sales and beer sales fall in 2 consecutive years. I haven't seen it happen in the last 5 to 10 years, and we went through the worst financial crisis in many decades. Now, some people might have the concern that, since we're legalizing marijuana, that perhaps people might not buy tobacco and they might not buy cigarettes. Well, guys, I also think that these cigarette companies like Lorillard and Philip Morrison will continue to make cigarettes, but they will also make marijuana. They will plant marijuana and they're going to put it inside of their I don't know what they're going to use, maybe a wrap, some sort of wrap, I guess. Or maybe they'll make it look like a cigarette, but instead of having tobacco inside of it, you will have marijuana inside of it. So I don't think that added competition from marijuana will be a very big deal, at least not in the short term, and even in the longer term. People trust the Marlboro brand for tobacco and marijuana anyway. So that's just my outlook on the whole entire tobacco industry. Bye. I think that to be defensive in this market, we should seriously consider tobacco as a reasonable substitute. Now let's talk about a reasonable substitute for a defensive portfolio. Now, if you're really aggressive on risk, well, maybe tobacco and beer is not for you. But personally, I think that if you want to defend your money and keep it safe and use it productively, then tobacco and beer and marijuana might be the way to go. So let's move on to the next chart, which is NVIDIA. So NVIDIA right here. Okay, so NVIDIA, it has had a very, very negative downwards trend, and this has been the case for all semiconductors, but also just the computer industry as a whole. Demand for computers is dropping, it's becoming more of a commodity, and people just don't feel the need or drive to necessarily upgrade their computers on a regular basis anymore. So that's a problem. However, as you guys saw earlier in that horizontal trend line, I think that horizontal trend line indicates that perhaps NVIDIA could be due for a reasonable bounce. It is a horizontal line extending over the past year, no, 2 years literally. So it's a very strong support area, and I think that we could be due for at least a 3 or 5% bounce from those levels. So right now it's trading at $11.40. The volume is abnormally low. All in all, this indicates that NVIDIA could be due for a reasonable bounce. Of course, gamble as you wish. It is a bit of a risk. Okay, so moving on. Let's talk about the next low-risk, high-reward play that I think about. So I talked about Lorillard. Well, now I'm going to be talking about Philip Morrison. I've been a fan of Philip Morrison since $60 per share. But right now, again, it is pulling back. It might fall even a little bit lower, but I think we're in a reasonable range where you should be considering Philip Morrison if you want to be a defensive investor in this market. Now, again, if you guys ethically feel that, oh, I don't want to own tobacco companies, I don't want to own beer companies, I don't want to own potential marijuana companies, that's fine. I'm not saying that you have to. All I'm saying is that it should be considered as an option for protecting capital. So let's move on and let's talk about silver. SLV iShares Silver Trust. Now this SLV is holding on to that 20-day moving average for now. I haven't seen it close below the 20-day moving average, but I am still a bit of a pessimist. I think that this recent upwards move is temporary. I think it's going to eventually fall down. And the main reason why I think it's going to fall down is because silver, again, has had a very good run previously. I called the rally on it, but I also think it's time to start looking at it and start objectively saying, yes, it's time we unload and wait for a better entry. Yes, we could have a decent rally. We've had a decent rally. I was expecting relief rallies throughout, but a downtrend looks something more like this, guys. You know, it just goes up a little bit and then down a little more. So it's like, right? And you know, it's you know, in a downtrend, you see the value of your asset go up. And you're like, oh yeah, you know, this thing's gonna head higher. It's gonna reverse and it's gonna go straight to the moon. And I think not. I think this is just another wave, and I think that it's gonna continue falling. That's just my outlook on it, and I don't think it's time to start buying silver quite yet. And the main reason why I feel pessimistic on silver is because the euro-US dollar will continue to fall. That will cause the dollar to rally, and a strong dollar is generally bad for commodities. Now moving on, Standard & Poor 500, we had a small relief rally on the session today. Small relief rally, right? We had a decent relief rally. It kind of bounced a little bit. I think it was like 0.2% of bounce. It's not much. It's a Friday, guys. And, you know, nobody really trades on Friday that actively. We already had a pretty weak week, so awful week. And, you know, logically speaking, it's usually the shorts that cover that keep the market afloat and stable. If you had a strong week, you know, like maybe let's say you advanced 300 points on the Dow, it's usually some people do some profit taking on Friday. Well, now it's the opposite. We lost maybe around a good 300, 400 points on the Dow. So now what's going to happen is that people are going to cover their short positions on Friday, and that's what's going to keep the market a little elevated. Now, I've been a huge bull on bonds, and I guess you guys are wondering, why are you so optimistic on the bond market? Well, bonds, here's the two things that are good about a bond, right? It appreciates in value if the interest rates continue to fall, and it still pays you interest while interest rates continue to fall. So there's two aspects of it. A, the interest rate does do you good, but two, the actual bond note does appreciate. And let me just illustrate this to you by looking at a TIP ETF bond portfolio, because the bonds themselves are appreciating, which is causing the stock itself to react positively. All right. So this is the past 2 years on the TIP. And as you guys can go ahead and notice, there is a consistent uptrend right here. It's consistently forming an uptrend. And I have to be an optimist. I mean, I like bonds because they're in a consistent uptrend. And that's all we should really care about. Is this asset going to continue to protect money? And will it not only protect money, but give reasonable yields? And it is, and I can honestly answer the question that yes, it will do both. It will give you a reasonable 2% yield based on what's going on today, and it is still in a long-term uptrend, which makes me think for a second, why should we take on so much additional risk in this market when all you have to do is buy bonds? Very simple. Even though the stock market has rallied throughout this whole period, you also notice that the value of the bond ETF has also gone up through this whole period as well. So that's just something to think about. If you feel uncertain or you feel uneased, and you're nervous and you don't want to lose money and you don't want to get carried away, bonds are probably the best way to go. And especially right now with all this volatility in the marketplace, what better than to buy the TIP bond ETF? So let's move on and let's talk about TripAdvisor Incorporated. So this is a stock that I'm going to be raining the pessimism on. Basically, I'm a little pessimistic. I don't think the stock is going to head much higher. I think that in fact it's going to correct pretty soon. So let's look at this real quick. For all of you guys who are scalpers out there, maybe there's going to be a scalp position set up pretty soon. It is a gap window right there. It's hitting that trend line pretty soon. Gap window, trend line, might go up a little bit more, but I think it's going to pull back eventually, and you guys will be able to short the stock and make a bit of some money, albeit a small scalp position would probably be best because, again, it's a bit of a risky gamble. So let's move on to the US dollar Japanese yen. So the US dollar Japanese yen, here's what happened. The US dollar did appreciate against the Japanese yen. Again, not sure why exactly, but that's just what the markets are doing. They're just dumping their dollar positions, and not really dumping, but they're dumping their Japanese yen positions. And I can see why. The Japanese yen has been on a very, very long downtrend, and at some point I felt that the Japanese central bank was going to do some currency intervention to keep their currency afloat, to keep the exports somewhat still competitive, and they would have, and I think it's pretty reasonable that Japan and the Japanese central bank may continue to do something to keep their exports alive before they get completely killed by being overly expensive. So let's move on to the next chart, which is the dollar index. Now, this is what I really like to talk about, the dollar index. Now, yesterday I was talking about the uptrend continuing. Well, it has continued, guys. A strong uptrend. Very basics, guys. If you're in an uptrend, what do? You just keep on buying and waiting and buying and waiting and buying and waiting. Again, very simple. It is having some issues breaking above that 200-day moving average. I already mentioned that, guys. It's something we should have all anticipated already, right? You hit a 200-day moving average. It's hard to break above a 200-day moving average, but eventually it gets done. Not today. It's a Friday. I don't expect it to happen for maybe 2 or 3 more days, but it will happen. I think the dollar is still in a sustained uptrend, and I don't think anybody should bother trying to debate that, at least not yet. Visa. So Visa Incorporated. This is one of my favorite stocks of all time. Now, some people are busy, over there at Apple saying, "Oh my gosh, Apple is this and that, and Apple's generating all these earnings, and now they're the biggest company." And yes, if anyone who rode the Apple train did very well. But what other great out there? What else is there that we could buy and make good yields and consistent yields and have a very, very strong and reasonable growth rate? Well, my response to that would be Visa Corporation. Now, I've been a big fan of them since $60 per share. Currently, what's the price? $142 per share. I've liked them since $60 per share. They are now $142 per share. Am I a fan of Visa? Yes, I am. And the main reason why I like Visa so much is, again, every single time you take your debit card, you pull it out and you go to your convenience store and swipe it. How much money does Visa make? They make 45 cents per transaction. So they're basically a transaction tax. What is so good about a transaction tax? First, it's consistent. Do people stop consuming money with their debit cards? The answer is no. I've never seen somebody stop and say, hey, wait a minute, I want to use paper bills more often. Have you? No. I mean, come on, guys. I mean, number two, Visa is growing rapidly internationally, and it doesn't take much for developing economies to adopt a Visa network. It doesn't take much, basically, for consumers to stop using cash and using a card instead. And again, with so many transactions, I mean, you know, if you think about it, in a single year, if there were $100 billion transaction, 100 billion transactions, not $100 billion worth of transactions, but 100 billion transactions were to happen in a single year on the Visa network, and they charged 45 cents per transaction, that would result in $45 billion in revenue right there alone. So that gets you thinking, well, will we, you know, is it possible, I mean, for people to do 100 billion transactions? And the answer is actually it's very easy. I would have to look at the financials and the growth rates again, but they are really strong growth rates. I don't have the numbers right off the top of my head, but in a video where I specifically cover Visa and just Visa only, I'll be talking a lot about the growth rates and the stuff and the specifics. But all I can tell you, though, is that this stock is in an uptrend. It is a growth company, strong fundamentals, no debt. If any debt, there's probably very little debt. And the dividends are good. So you got dividends, you got growth, and you got safety, and you got just all around. It's a really great investment. It reminds me of Apple, but the Apple of financial services, which again, I don't like financial services companies. I don't like insurance. I don't like banks right now. I don't like European banks. I really hate European banks. In fact, I think European banks should not be a part of your portfolio whatsoever. But I think Visa should be in there. If you want exposure to financial services, the only company I think is going to do very well, exceptionally well, super duper well, is going to be Visa. Okay, so let's move on to the next chart, which is ExxonMobil. But before I do, I think I should show you the Visa chart one more time. Really, really strong, clean upwards trend. Very strong. Very clean. It doesn't take a rocket scientist to say, I got it. This makes sense. It looks like the bond uptrend, in fact, but at a much faster rate of growth. So again, let's talk about the ExxonMobil. ExxonMobil is holding on to the 200-day moving average. 200-day moving average is holding on to it. It's doing okay right there. And wow, this is much better. I think I'm doing a much better job of showing you guys the chart. But right there, see, it's holding on, and ExxonMobil is most likely going to continue to fall below that 200-day moving average. Why? Because stocks tend to hold on to the 200-day moving average. But again, you know, people think, well, isn't crude oil a good defensive play? It usually is, but there are many products out there in the marketplace that also are inelastic, that being tobacco. Tobacco is inelastic. Beer is inelastic. Credit card services, inelastic. Why is it inelastic? Because even though you have alternatives between MasterCard and Visa card, the very nature of transacting is inelastic. Crude oil, inelastic. Problem, though, being a crude oil supplier, even though you're supplying an inelastic product, you are still exposed to the pricing fluctuations of that product. And crude oil as a commodity is in a downwards trend. The price of crude oil is in a downwards trend. And again, I want to mention that crude oil will continue to be in this downwards trend for quite a while. Why do I think it's going to be downtrend for quite a while? Well, because I think the euro-US dollar is going to break down and continue to fall. That's going to cause the dollar to rally. When the dollar rallies, commodities respond very negatively. And what's going to happen to crude oil when the dollar continues to rally? Well, crude oil prices will continue to fall. What will ExxonMobil's performance be if in the event the price of crude oil falls? They will make less money, which is why I don't think ExxonMobil should be a part of a defensive portfolio unless if you're managing $100 billion. If you manage $100 billion, then you really have no choice but to buy ExxonMobil because you have so much cash to manage. But if you're not in that position, why would you expose yourself to a defensive player that has exposure to crude oil prices, a commodity price? It doesn't make sense. There are many other products out there that are inelastic. If you want to buy something inelastic and a company that sells an inelastic product, then tobacco, Visa cards, and beer is probably the best way to go. So that does it for me today. And yes, I did skip out a couple things like biotechnology companies, insulin, stuff like that. That also makes sense too. But to me, I think in terms of consumer products and Visa, beer, and cigarettes makes the most sense to me in a defensive portfolio right now. And I would mention McDonald's, the restaurant, but again, McDonald's restaurants, McDonald's did miss out on their earnings. Same-store sales did fall for the first time in the United States in a couple decades. So yes, even restaurants, even though they have somewhat of an elasticity and their growth has been exponential over the past decade, it's time to close the books on restaurants and start focusing more on inelastic consumer goods. And I already mentioned them 3 times, but one more time: beer, cigarettes, and Visa cards, MasterCards, those work. All right? So you guys have a wonderful night. I hope you guys make money every single day of the year, and I hope you guys have a wonderful Thanksgiving, and I also hope you guys have a fun, productive, and wonderful weekend as well. So take care, folks. You guys just have fun, all right?